Debt to income ratio, what is it? Why do we care so much about it? It's also called your DTI. You might hear this tossed around a few times when you're getting your mortgage. Debt to income ratio is your total housing payment, including if you have an HOA, it's principal, interest, taxes, and insurance, and possibly the HOA, plus the minimum amount due on your monthly bills, your credit cards, your car loans, student loans, if you have child support, all those things added up. Those numbers divided by your income. You want to have as low of a debt to income ratio as you can, obviously, because you don't want to max out your debt. When you're buying a home on a conventional loan, we kind of like to keep it 45% or less. 45% of your income, your gross income, is going towards all of your debt. On FHA, you can push it to 56.99%. It depends on specific scenarios, but that is the upper limit. And then VA loans, they actually don't have a debt to income ratio that they look at. Instead, we look at residual income guidelines. We will evaluate that. And USDA has very strict guidelines. Your housing payment should be 29% of your gross income, and then your housing payment plus your monthly bills should be 41% or less of your monthly income. How do you decrease your debt to income ratio? You need to manage your debt. Number one, pay down any high interest credit lines. Pay more than the minimum payment to really attack that principal. Don't get payday loans. You might need to get a co-signer to help increase your income. And you'll always want to save up like 3 to 6 months of living expenses so that if there is an emergency, you have the reserves to cover that.